Welcome back to the Mortgage Reports. If you're a homeowner, you've probably heard the word refinance tossed around, especially when interest rates shift. But what does refinancing actually involve? And what do you need to qualify in 2025? Now, whether your goal is to lower your monthly payment, pay off your mortgage faster, or pull out cash for renovations or debt consolidation, this video breaks down everything you need to know in a simple question and answer format. Let's get into it. Question 1. Why would someone want to refinance their home? There are several reasons people choose to refinance, and it often comes down to improving their financial position. The most common reason is to lock in a lower interest rate. Even a small rate reduction, say 0.5%, can save you thousands over the life of your loan. Now, some homeowners refinance to shorten their loan term, switching from a 30-year to a 15-year mortgage to build equity faster and save on long-term interest. Now, others refinance to change their loan type, such as moving from an adjustable rate mortgage, known as an ARM, to a fixed rate loan for more stability. Then there's the cash out refinance, which allows you to borrow against your home's equity. This can be a smart move if you want to fund major home improvements, pay off high interest debt, or cover big expenses like tuition. Just keep in mind, refinancing resets your loan terms, so always make sure the move lines up with your long-term goals. Question 2. What are the basic requirements most lenders check? Now, every lender has its own process, but most look for the same key factors before approving a refinance. The first is credit score. For a conventional refinance, most lenders want to see a minimum score around a 620. Though the higher your score, typically the better your interest rate options are. A solid payment history on your current mortgage also goes a long way toward approval. Next, lenders evaluate your home equity, which is determined through a loan-to-value ratio, or LTV. Ideally, you should have at least 20% equity, meaning your new loan is no more than 80% of what your home is worth. Having more equity not only helps you qualify, but can also eliminate private mortgage insurance, or PMI, and get you better terms. Another big factor is your debt to income ratio, known as DTI. This shows how much of your monthly income goes toward debt payments, including your mortgage, car loans, and credit cards. Now, most lenders prefer a DTI under 43%, but some programs are more flexible. You'll also need to verify your income and employment, so expect to show recent pay stubs, tax returns, or bank statements. And if you're self-employed, you'll likely need to provide business tax returns and a profit and loss statement. Lastly, lenders may look at your cash reserves, especially if your financial profile is on the edge. This means having enough in savings to cover a few months of your mortgage payments after closing. And speaking of closing, don't forget closing costs, which typically run between 2% and 5% of your loan amount, though in some cases, you can roll them into a new loan balance. Question 3. Are there refinance programs with more relaxed requirements? Yes, and this is great news for homeowners who might not meet every conventional guideline. Government-backed refinance programs often have more flexible rules. For example, the FHA Streamline Refinance is designed to make refinancing simpler and faster for current FHA borrowers. It doesn't usually require income verification or a home appraisal. Similarly, VA IRRRLs, which stands for Interest Rate Reduction Refinance Loans, are available to eligible veterans and active duty service members. They allow you to refinance to a lower rate with minimal documentation and no appraisal in most cases. But remember, even with government-backed programs, lenders can set their own stricter rules called overlays. So one lender may be way easier to work with than another. That's why it pays to shop around. Question 4. What documents will I need to provide? Think of it as deja vu from when you bought your home. Typically, you'll need your most recent pay stubs, W-2s, and tax returns to verify your income. Lenders also request bank statements to confirm your assets and review your financial stability. If you're self-employed, expect to provide additional documents like business tax returns, 1099 forms, and a profit and loss statement. You'll also need to show proof of homeowners insurance, since lenders want to ensure the property is properly protected. And just like when you first bought your home, you'll need a new title insurance policy, which protects both you and the lender against potential ownership disputes or liens. Having all of these documents ready before you apply can save you time and headaches during the underwriting process. Question 5. Can I refinance without getting a new appraisal? In some cases, yes, you'll need an appraisal. Lenders want to verify your home's current value before approving a new loan. However, there are some exceptions. Some streamlined refinance programs through the FHA, VA, or even certain conventional options like Fannie Mae's appraisal waivers allow qualified borrowers to skip this step. If your mortgage history is strong, your loan amount is modest compared to your home's estimated value, and the lender has access to recent automated valuation data, they might be able to approve your refinance without an in-person appraisal. This can make the process faster, simpler, and sometimes cheaper. That said, if your home's value has increased since you bought it, getting an updated appraisal could actually help you. A higher appraised value means more equity, which could help you drop PMI or even qualify for better loan terms. Next question. How strictly do lenders enforce these rules? It really depends on the lender. The big agencies, Fannie Mae, Freddie Mac, FHA, VA, set the baseline, but lenders add their own spin. One lender might allow a DTI of 45%, another caps it at 40%. Some might want higher reserves or credit scores if your file's a little thin. That's why getting multiple quotes matters. 3 lenders, 3 different answers. It's totally normal. And don't forget, closing costs and fees also vary, so compare and negotiate. So there you have it. The key things you'll need to qualify for a refinance. Refinancing can be an amazing financial tool when it's done for the right reasons, but preparation is everything. Make sure you understand your equity, your credit, and your goals before starting the process. If you found this breakdown helpful, don't forget to hit the like button, subscribe for more home finance insights, and drop your refinance questions in the comments. And check out our website, The Mortgage Reports, for the full article. Thanks for watching, and I'll see you in the next one.